When it comes to saving and investing for retirement, everyone wants to beat the stock market. You beat the market, you retire with more money. It's just that simple. But if you were lucky enough to beat the market, then probably one of two things happened. Either you got lucky, or you took significant extra risks in your investment decisions. Now, in a perfect world, not only would you outperform the stock market, but you would do so in a significantly safer manner. But that would almost be like finding a unicorn, right? Hi everyone, my name's Ben, and this channel is dedicated to all things personal finance related. And today, I'm here to tell you that unicorns are real. At least in this case. So in this video, I'm going to talk about what I feel is the single most perfect investment to put in your retirement accounts. Not only does this investment generate better long-term results, but it does so significantly safer than investing in something like a broad stock market index fund. Now, if you haven't already figured it out, the product that I'm talking about are REITs. Now, the modern day REIT came in the market in the late 70s, and since then, they have outperformed the broad stock market as measured by the Russell 3000 at a rate of about 12.8% rate of return for REITs versus about 11.6% for the broad market. Now you might be saying that's only about a 1.2% difference. And that may not sound like a lot, but thanks to compounding, that can create massive differences over time. So if you were to invest $4,000 a month for the next 40 years into your retirement account when you start at, let's just say 20 until you retire at 60, if you invested in the traditional stock market and got that 11.6% rate of return, you would come out with close to about $2.8 million. Pretty good, but had you invested in these REITs and got that 1.2% more, then you would retire with about $3.9 million. That's over a $1.1 million difference, or about 40% more money. So then what exactly are REITs? Well, REIT is just an acronym that stands for Real Estate Investment Trust. It combines a lot of the benefits of owning real estate with the ease and simplicity and liquidity of owning stocks. So essentially all it is you are buying stock in a particular company, and that company specializes and owns real estate. Now, the first way that these REITs are going to outperform the broad stock market in the long run is, since real estate is a physical, tangible asset, it is a commodity, that means it is also a natural hedge against inflation. Since every country on earth has a positive rate of inflation, that means every year all of these physical goods that you're going out and buying are costing more and more money as time goes on. And that means that this real estate that this company owns is going to be worth more and more money each and every year. And this is in contrast to a stock like Walmart, whose stock price is tied to sales, profits, and revenue. But there's nothing that says that Walmart's revenue next year is going to be more than it was this year. But you can pretty well guarantee that real estate is going to be worth more next year than it was last year, thanks to inflation. And the second reason why REITs are going to outperform the broad market is literally everyone needs real estate. Everyone needs a place to live, and everyone needs a place to conduct their business. Since populations are naturally rising, but there is a fixed amount of real estate, that means that demand for real estate is going up, but there's only a limited amount of supply. And by the law of supply and demand, that means that over time, the cost of that real estate is going to go up and up and up. Not only that, but on a monthly basis, you're going to be collecting rents, whether that's rent from a residential apartment complex or rent from businesses. Maybe you're operating a strip mall or something like that. And these rents are very consistent. You know exactly how much money this apartment complex is supposed to generate on a monthly basis. But other companies, sometimes they have really good quarters and sometimes they have really bad quarters. Their income levels fluctuate dramatically, whereas real estate is very steady. And the third reason these are going to outperform the broad market is because they're not taxed at a corporate level. You see, any money that a REIT generates as profit, they distribute to the shareholders in the form of dividends. And as long as they give out at least 90% of their profits to shareholders as dividends, then the company itself is not taxed at the corporate level. And that's a big deal because somebody like Walmart, if Walmart makes a profit, the federal government is going to take some taxes, the IRS is going to take their cut, and then anything left over, Walmart is able to give to the shareholders as dividends. But since they're not paying this tax at the corporate level, that means there's more money to give to you, the shareholder, in dividends. This fact alone causes the dividends for REITs to be astronomically high. And I know there's a lot of famous YouTubers out there that are all about the dividend lifestyle. And why not? Dividends are great. But REITs pay on average about a 5% rate of return for dividends. And this is opposed to the broad S&P 500 that averages, give or take, about 1.9%. And these dividends are made possible by the fact that these companies are not taxed at the federal level. It means they're able to pass more of the profits directly onto you. Now at this point, I can hear some of you guys saying, well, but if these REITs are so amazing, then why don't all of these hedge fund billionaires just go and buy up all the REITs? Like, why would they own any other type of stock if REITs are so fantastic? Well, REITs are fantastic, but they do have one major downside, which you can avoid, but these hedge fund billionaires cannot avoid. You see, while these REITs pay ridiculously high dividends, these dividends are treated a little bit differently than most dividends when it comes to tax season. You see, most dividends are taxed at a very favorable long-term capital gains tax rate, which for most people it means about a 15% tax bracket, or if you're super rich like Warren Buffett or Bill Gates, you get taxed at 20%. But even then, 20% is very good. REITs, on the other hand, do not get the benefit of this long-term capital gains tax rate. These dividends are treated as ordinary income, which for wealthy folks, that goes all the way up to 37% tax bracket. And that's why these hedge funds, yes, they still buy REITs, but it's not overwhelmingly good for them like it is for us, because they would rather have options that give them these much more favorable dividends, these long-term capital gains, as opposed to ordinary income, which is taxed significantly higher at 37%. So how does somebody like you avoid this? Well, put it in your retirement account. You see, all retirement accounts grow tax-free, which means that these dividends paid by these REITs are not going to get taxed at all. It's just going to simply accumulate and continue to grow. So your tax bracket when it comes to these dividends is zero. That's why if I were to show you which stocks that I own in my retirement account, every single one of them is a REIT. I own some residential apartment complexes. I own a different REIT that specializes in senior care facilities. I own data centers. I own all kinds of different real estate investment trusts. So these four reasons are what makes real estate investment trusts so phenomenal and why they beat the long-term stock market. It's a natural hedge against inflation. You collect nice, neat, stable rent checks every month. These companies are not taxed at the corporate level, and since you're holding these REITs in some sort of a retirement account, you can avoid that very unfavorable ordinary income that these dividends generate. So your tax rate for these is going to be zero. And that's why that these REITs are significantly better for you as opposed to some hedge fund billionaire, because they're paying 37% tax on all of this stuff. So not only are these REITs going to outperform the stock market in the long run, potentially getting you up to 40% more money in your retirement account, but they're actually safer than the broad stock market. Now, I'm not going to get into the math behind it, but professional investors have developed a mathematical formula to quantify risk. It's known as the Sharpe ratio. So if you were to look at this chart, the perfect investment would be all the way up and to the left, making a lot of money at a very, very safe investment. And down and to the left is a low rate of return that's also very risky. But if you look at this chart, you'll notice that the one most up and to the left is real estate. In fact, as far as risk goes, real estate is right around the point where various corporate and government bonds are as far as risk, but they provide significantly higher rates of return. So that's going to wrap it up for us today, folks. If you found this video useful, be sure to subscribe, leave a comment down below. I love hearing from you guys. And as always, I'll see you all again next time. Thanks.